You want to build wealth, but keeping your cash hidden under your mattress is basically setting it on fire. Inflation slowly eats your money's value every single year. You need a machine that grows your money faster. The stock market is that machine, but finance bros in expensive suits make it sound incredibly complicated. Today we are stripping away the confusing jargon. No suits, no confusing math, just the exact blueprint. Let's start with the absolute basics. Imagine a billion-dollar company isn't a boring office building. Think of that massive company as a giant, highly profitable, perfectly baked pizza. A stock, sometimes called a share, is simply one single slice of that giant pizza. When you buy that slice, you are legally buying a tiny piece of the actual business. You aren't the CEO. You can't fire the marketing team, but you are a fractional owner. If the company cuts the pizza into 1 million slices and you buy one, you are 1/1,000,000th of a boss. But why would a successful company sell slices of themselves to total strangers? Because expanding a business costs massive amounts of cash. They want to build 50 new factories. They could go to a grumpy bank and borrow the money, but the bank will charge them heavy interest. Or they can go public. They sell slices to everyday people to get the cash they need right now. The company gets the money to grow their empire, and you get your slice. It is a trade. So why do you want this slice? To get richer without doing any actual physical work, obviously. There are two ways you make money. The first is called capital gains. Let's break the math down. You buy a slice of a sneaker company for exactly $10. You hold on to it. A year later, the company invents a revolutionary new shoe. Suddenly, every kid on earth wants to buy it. Because the company is doing great, demand for their slices shoots up. Everyone wants to own a piece. You decide to sell your $10 slice to a desperate buyer for $30. Boom, $20 pure profit. The second way to make money is dividends. Some massive, stable companies make too much profit. Instead of building more factories, they just hand the extra cash directly to you as a thank you. It's literally a cash reward just for holding the stock. It shows up in your account every few months. What's the catch to all this? The catch is that your slice can turn into total garbage overnight. If the company makes an exploding product or goes bankrupt, nobody wants their slice anymore. The slice you bought for $10 drops to 50 cents. If you panic and sell, you lose your money. The stock market goes up, but it absolutely goes down too. Welcome to the risk factor. But who even invented this crazy, risky system? To find out, we have to travel back in time. The true story of the stock market involves wooden ships, deadly pirates, and very expensive pepper in Amsterdam. Back then, spices from Asia were worth a fortune, but getting them meant a terrifying 2-year ocean voyage. It was a massive gamble. If one rich merchant funded a ship and a storm sank it, he lost everything. The risk of going instantly bankrupt was simply too high. So the Dutch East India Company had a stroke of genius. Instead of risking their own cash on one ship, they asked thousands of regular citizens to chip in. The baker, the blacksmith, and the farmer all gave a few coins to help fund a massive fleet of ships. In return, the company gave them a piece of paper proving they owned a tiny fraction of the voyage. Because the risk was spread out, it didn't matter if one ship sank. The others would still make it back. When the fleet returned, loaded with treasure, they sold it all and shared the massive wealth with the paper holders. But there was one major flaw. Voyages took years. What if an investor had an emergency and needed cash immediately? The company wouldn't do refunds. So investors went to local coffee houses to sell their papers to other citizens. This created an absolute frenzy. People traded entirely based on rumors coming in from the sea docks. If someone yelled that pirates took the fleet, everyone panicked and sold their paper for pennies. That chaotic, rumor-driven trading became the world's first stock market. And honestly, not much has changed today. Fast forward to the modern era. You can't just walk into Wall Street with cash and ask for one Apple share. The exchange is strictly a wholesale market. You need an authorized, highly regulated middleman. That middleman is officially known as a broker. They are the only ones allowed to buy the stock for you. In the 1980s, your broker was a stressed guy in a suit yelling into a giant plastic telephone. Today, your broker is just an app on your smartphone. You download it and link your bank account. The app builds a highly secure, digital pipeline directly from your couch to the chaotic stock market floor. Why do we need them? The exchange processes millions of trades a second. The broker does the background checks. When you tap Buy, the broker app grabs the stock from a seller and puts it safely into your digital account. You can place a market order to buy it instantly at whatever the price is, right at this exact second. Or use a limit order telling the app, only buy this if the price drops to a specific bargain number. Okay, your broker app is funded and ready. Now comes the incredibly hard part. Which company do you actually buy? When you pick individual companies, you have to do what the financial nerds call fundamental analysis. Think of picking a stock like buying a used car. You don't just stare at the shiny red paint job. You have to make sure that engine isn't rusted out garbage. Same applies to stocks. You have to scan companies of respective stocks before buying. You have to look for 3 vital signs of life. Number 1, consistent revenue and profit growth. Are they selling more products this year than they did last year? If sales are flat, the stock goes nowhere. Number 2 is debt. How much money do they owe the bank? High debt in a bad economy is a death sentence. Number 3 thing we have to check is that, does the company have a powerful brand or patented tech that makes it impossible for rivals to steal their customers? Even if the company is amazing, you have to check the price tag of the stock. Here comes the PE ratio. Price to earnings tells you exactly how much you are paying for one single dollar of their actual profit. Next, look at their future. Are they inventing the next big tech trend? Or are they still selling DVDs? Finally, do you trust the management? A brilliant company run by a chaotic CEO can destroy your money with one bad decision. The brutal truth? Doing fundamental analysis properly takes dozens of hours of reading boring reports and math. You have to monitor the news daily. It is essentially a highly stressful, unpaid part-time job. Most regular people simply do not have the time, the patience, or the desire to do this much homework. But what if you want stock market profits without doing any of the actual stressful research? Welcome to the ultimate cheat code for wealth building. The glorious, stress-free invention known as the mutual fund. Let's break down how this magic works. Think of a mutual fund like a giant community bucket. Instead of you buying one stock, thousands of everyday people throw their cash into this one big communal pile. That massive pile of money is handed over to a highly educated professional, officially called a fund manager. Their full-time job is to take that giant bucket of cash and go shopping in the stock market for you. They buy tiny slices of 50, 100, or even 500 different, well-researched companies. They blend all those stocks together into one single product. Like making a massive financial smoothie. When you put $100 into the mutual fund, you instantly own a microscopic crumb of all those companies. There are 2 main flavors of this. Active funds have a human manager trying to pick the absolute best stocks. Passive funds, also called index funds, just use an algorithm to automatically buy the top 500 companies. Index funds are incredibly cheap and highly effective because you aren't paying a human a massive salary to guess. But the real superpower of any mutual fund isn't just the laziness. It's a concept called diversification. We all know the saying, don't put all your eggs in one basket. Buying one individual stock is doing exactly that. A mutual fund spreads your eggs across hundreds of baskets. You own a piece of travel, healthcare, and tech. If a global event causes stocks of any one company in your basket to crash, you don't lose all your money. Why? Because the other companies in your basket are having a great year, and they balance out the loss. That is the ultimate financial armor. It lowers your risk of losing everything to almost zero. Plus, it saves your sanity. You don't have to check your phone every 5 minutes in a cold sweat. Over a 20-year period, lazy index mutual funds actually beat the vast majority of professional stock pickers anyway. So you picked a solid mutual fund. Now, you need the perfect vehicle to transport your money into it. Now enters the concept of SIP. It stands for Systematic Investment Plan. The name is boring, but the math is magic. You know what an EMI is. A forced monthly payment to a bank for a car or a phone. A SIP is simply a good EMI. It is a forced monthly payment directly to your future self. You make a rule on your app. On the 5th of every month, take exactly $100. Take that money and automatically buy more pieces of my mutual fund. Then, you never touch it again. Why is this automated system so powerful? First, it completely removes human emotion from the equation. Humans are terrible at timing the market. We buy when it's high due to hype and panic sell when it drops. The SIP doesn't care if the market is crashing. It buys relentlessly, building incredible financial discipline automatically. When the market crashes, stocks are cheap. Your $100 SIP automatically buys a massive pile on discount. Over time, this smooths out the cost of your investment perfectly, but the ultimate secret of a SIP is compounding. Compounding is widely known in the finance world as the snowball effect. Let's look at the math. In year 1, you start small. Your original money makes a tiny bit of profit. The snowball begins to roll. In year 2, your original money makes profit, and last year's profits start making their own profits. The snowball's surface area is now expanding. It is gathering snow faster and faster, with zero extra effort from you. By year 10, it is massive. By year 30, it has grown into an unstoppable, multi-million-dollar avalanche of cash. Because of how compounding multiplies, the actual dollar amount you invest is way less important than time. How long you let the snowball roll is everything. Starting with $50 a month at age 25 is incredible. That will easily beat someone who starts investing $500 a month at age 45. They simply don't have the runway. Time is the ultimate secret ingredient in the wealth recipe. The longer the hill, the bigger your financial snowball gets. The stock market used to be an exclusive club for rich guys. Now it's right there on your phone. Don't let the finance bros intimidate you. Buy the whole basket, set up your automatic SIP, and go live your life. Let the algorithms and the nerds do the heavy lifting, while your wealth builds silently in the background. You have the blueprint. The only thing left to do is start your snowball today, even with just $10. If this completely changed how you see the market, hit subscribe. We are building wealth together. See you next time.